138 per square feet during the financial year, which is an increase of 40% over previous financial year, driven by launch of premium projects. We achieved pre-sales value of rupees 7,847 crore rupees in financial year 25, a 31% increase over the previous year, and recorded collections of rupees 7,250 crores, reflecting a 23% year-on-year growth. We are steadily strengthening our presence outside of Bangalore in our key markets of Chennai and Hyderabad. In financial year 25, we launched 11.5 million square feet with a GDV of rupees 13,500 crores, of which 9.5 million was in residential projects with a GDV of 11,700 crores. Notable residential launches in Q4 includes Brigade Altius in Chennai and Brigade Eternia in Bangalore. We also launched Ebony, one of the final parcels in our 135-acre township, Brigade Orchards in Devanahalli, Bangalore. We continue to maintain zero residential debt across the group, driven by robust sales and collections. The market remains resilient with sustained demand across both new launches and ongoing projects, particularly in the sustainable and premium housing segments. As we look ahead, we are optimistic about maintaining this momentum in the upcoming quarters. Coming to leasing portfolio, it recorded a revenue of rupees 1,165 crores in this financial year 25, a growth of 24% over financial year 24. We launched 2 million square feet of commercial development during the year. Brigade Twin Towers saw reasonably good demand for both sales and leasing, particularly from manufacturing, flexible office space, and retail tenants, highlighting the continued need for quality office infrastructure. Overall, retail consumption grew by 4% year-on-year, driven by categories such as electronics, specialty lifestyle, and watches and accessories across all three malls. Hospitality, coming to hospitality thing, our Brigade Hotel Ventures Limited has filed the DRHP, the draft red herring prospectus with SEBI in October, and we received the DRHP approval. We are governed by publicity restrictions, due to which we will not be in a position to take any questions on the hospitality business or about the IPO. But happy to say the sector, our business has shown a 20% jump in business over the past year. With a robust pipeline for financial year 26, the coming financial year, pipeline of about 16 million square feet of developments across residential, commercial, and hospitality segments, we remain confident in our ability to deliver sustainable growth and long-term value for our stakeholders. I will now hand over to our CFO, Mr. Jay Manmadkar, to present the detailed financials for the quarter. Thank you.
Thank you, sir, and good afternoon to all. On behalf of the company, we welcome you to the earnings call for Q4FY25. Our chairman has already shared operational highlights. I will be sharing key financial highlights for the quarter and financial year 2025. We are happy to share that Brigade Group has reported its highest ever real estate sales value of rupees 7,847 crores for FY25, a growth of 31% over FY24. We also clocked the highest ever collections for the year amounting to rupees 7,250 crore, an increase of 23% over FY24. Net cash flow from operating activities stood at rupees 2,135 crore, an increase of 36% over FY24. To start with the group's performance for FY 2025, the real estate segment clocked a turnover of rupees 3,613 crore with an EBITDA of rupees 697 crore. The leasing segment clocked a turnover of rupees 1165 crore, an increase of 24% over FY24 with an EBITDA of rupees 771 crore. The consolidated revenue for FY25 stood at rupees 5,314 crore. Consolidated EBITDA stood at rupees 1,654 crore, an increase of 21% over FY24. EBITDA margin stood at 31%. Consolidated PAT after minority interest for FY25 is rupees 686 crore, an increase of 52% over FY24. Coming to the group's update for Q4 FY25, the real estate segment clocked a turnover of rupees 1,050 crores in Q4 FY25 with an EBITDA of rupees 240 crore. The leasing segment clocked a turnover of rupees 331 crore, an increase of 34% over Q4 of FY24 with an EBITDA of rupees 194 crore. The consolidated revenue for Q4 FY25 stood at rupees 1,532 crore with an EBITDA of rupees 488 crore. EBITDA margin stood at 32%. Consolidated PAT after minority interest for Q4 FY25 stood at 247 crore. Overall collections in Q4 FY25 stood at rupees 1,929 crore, an increase of 9% over Q3 FY25. Net cash flow for operating activities stood at rupees 586 crore, an increase of 30% over Q3 of FY25. Now about the debt and liquidity position. We continue to have adequate liquidity and undrawn credit lines from banks and financial institutions to support our growth plan. Our average cost of debt has been reduced to 8.67% as of March 25 from 8.82% as of March 24. CRISIL has updated our rating outlook to AA- positive from AA- stable on the basis of performance and financial stability. Gross debt of the group stood at 4,444 crores. The cash and cash equivalents was rupees 3,483 crore as of 31st March 2025. Consequently, company's net debt outstanding as of 31st March 25 was at rupees 962 crore, out of which Brigade share is rupees 199 crore. We continue to have zero residential debt driven by higher sales, real estate and collections. Almost 82% of the debt pertains to the commercial portion, which is backed by rental income. Debt equity ratio stood at 0.14 as of March 25 as compared to 0.62 in March 24. I will hand it back to the moderator for questions.
Thank you, sir. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi, Amar. Congratulations on a good quarter. So my first question is that you said that 11,700 crore was the launch value. So against this, how much was the contribution to this year's pre-sale of 7,800 from the new launches?
Yeah, so of the total sales that we did, we had about 54% coming from new launches.
Okay, 54%. So, Pavitra, my question is again, now we are expanding big way in Chennai. Yesterday also a big acquisition was announced. So first of all, I wanted to understand that what has been the velocity in the two projects, Icon and Altis, when they were launched. So release GDV versus sales we have done in this year. And how does it compare to Bangalore? And in context to that, I would like to understand that if the velocity in Chennai is lower, so we are expanding a big way, and also in Chennai our prices, especially when I look at Velachery, is almost 20,000 is what we have given. If I implied realization is 20,000, so which is a premium of 40%. So what are we developing there? So do you think market can absorb that kind of a product? So and how will be the sales velocity there?
Yeah. So definitely Chennai market is different from Bangalore. We don't even expect the same kind of launch pattern. In fact, we don't plan for it that way at all. So in Bangalore, whatever percentage that we're planning at the time of launch, in Chennai it's quite different actually. That said, both Altius and Icon had very good launches. Altius itself, we sold 100 units within the first month itself. Now we will see that stabilizing, and then we see that going at a more sustenance kind of rate, as opposed to trying to sell everything in a very short period of time. So I think we have to do our sales before completion of the project, and that is actually a normal state of planning our sales. I think in the last few years, everyone's gotten used to selling in a very short period of time, which is not a normal situation. It's a good situation, but it's not typical. So in Chennai, we expect to see the same, and the kind of pricing and sales velocity that we have planned will be on those lines. In Chennai also, all of our land parcels are extremely high quality, really well located. They're in very good neighborhoods. So naturally the pricing that you're seeing is reflecting that. It's not that it is not in a premium area and we are charging something and positioning a product that's not in line with that sub-market. So yesterday's acquisition included that. An excellent parcel. It's right next to Phoenix, the mall and Palladium Mall, and Westin Hotel as well. So it's a fantastically located parcel, and I think the pricing there is fair. So overall, I feel both markets are strong. Bangalore still moves very differently, especially at the time of launch. But both are, markets that we're very confident of in the coming couple of years as well.
So, just to get some numbers, so this Altus project in Chennai, so what was the launch value and how much have we sold in that in terms of crores?
So the launch value, the ticket size is around 2 crore or so. We've done about 100 units, so we've done 200 crores. There's totally about 662 units.
So out of 1,200 odd, you have booked 200 crores of sales, and that will be the right assumption. Okay, got it. And just one question on the embedded EBITDA margins. Now 1,700 crores of pre-sales, 1,700 plus. So what could be the embedded EBITDA margin in this pre-sales for this year, FY25?
Sorry, could you repeat the question?
So we have recorded 1,700 crore plus of pre-sales for this financial year. So what will be the embedded EBITDA margins in this?
We expect it to be, we will aim to be on the similar lines what we have achieved this year. But at the end of the year, only we will know the exact figure. Too early to fully predict.
No, sir, I'm talking about the pre-sales number. So, I mean, residential EBITDA margins are 19%. That is because of the CCM accounting.
It will be in similar lines. It will be in similar lines.
I think we were target. I think last call we have said 27 to 28% is what we'll be targeting from the new
pre-sales. We have done better than that. This year we have done better than that. That will be the desire to keep the EBITDA better than 27-28%. Generally, we aim to make it about 30% plus.
Okay.
But it's all a factor of market conditions and the project to project EBITDAs. And overall, when it gets averaged, it can vary a percentage or two.
Okay. This last question to Jayant. Jayant, is 3,483 crores of cash. So how much is it in RERA escrow, and what will be the free cash which can be used for acquisition and land acquisition and growth?
So as of 31st of March, about 1,100 crore is the free cash. Then about 480 crore is the cash which is out of QIP that we have to use, and balance is in RERA.
Okay, so approximately 1,500 is free cash which can be used for growth.
Yes. As of 31st.
Okay. Thank you, team, and wish you all the best.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Pritesh Seth from Axis Capital. Please go ahead.
Thanks for the opportunity and congrats on the great year. First is in terms of launches for this year, it's almost 12 million square feet. How would you split between the three markets or rather two, I think? Yeah, you can help me on that.
We have 12 million square feet across residential. In that, it's about 5.5 million in Chennai and approximately the same in Bangalore, and about 1 million or so square feet from Hyderabad. We also have 500,000 square feet coming from Mysore this year.
Got it. And so in terms of value, it should be like same 12,000 odd crores. 10,000 per square feet would be the blended relation.
Yeah. Average of 10,000 rupees is what we are assuming.
Got it. Just for Bangalore, we were probably last year we were planning to scale up our launches in Bangalore from this 5.5-6 million square feet kind of a run rate to more of 7.5 million square feet. But now we are back to again that 5.5 million square feet run rate, which we have been doing since last 5-6 years. Do you think that at the scale at which we are in Bangalore, there is some constraint, of growth there, and large part of our growth will come from Chennai, Hyderabad, or is my reading that way is incorrect? Yeah.
No, so in general, we still expect Bangalore to be a very large driver of our growth. Every quarter, every year, these numbers can change a little bit based on approval cycles and so on. In Bangalore as well, I would say there are a couple of land parcels where we pulled back from acquiring because some of the land cost was a little bit higher. So in some cases, we have not gone forward. I think we are still very bullish about Bangalore as a whole in terms of residential, and we still have some large projects coming up in the pipeline for us in the next 4 quarters and beyond. And wherever it's possible to pull up what is in our land bank and bring it into the coming 4 quarters, we'll do that. Even in our land bank, we have substantial amount of pipeline from Bangalore itself. It's just a matter of the approval cycle and getting it into the pipeline earlier.
Sure. And just to continue with that, what's in general the conversion cycle in Bangalore now, right from acquisition to eventual launch? Has there been any favorable favorable timeline there, or there are still things which are delayed?
Yeah, compared to 2 years back, you can say we are adding about 2 months delay compared to 2 years back. But still, we generally say for large projects, we still keep in mind about 12 months as the launch cycle. If we do before that, it is we treat it as a plus. If we do later than that, it is a slight minus. But normally, on an average, we can take it as 12 months. But our record in many cases is about 10 months.
Got it. That's very helpful. And just one last on residential, Hyderabad. This we would exhaust our pipeline this year. What more we can see in Hyderabad? Are we doing some transactions? This year?
Yeah, we have tied up another 1 million square feet plus, which is we have entered into MOUs, etc., and it's in advanced stages of planning. And we're in the process of finalizing another 1 million square feet, and we're waiting for some public level auctions for us to participate.
Okay. And eventually, you think
we hope to launch this year. New projects we plan to acquire.
2 million square feet of new project to be acquired.
New projects, out of which 1 million we have signed up, another 1 million we are in the process.
Got it. That's very helpful. And
this is
eventually, do you think
this is apart from This is apart from 1 million,
1 million square feet. Yeah.
Approved project which is to be launched.
Yeah. And eventually, given the supply which we are able to create in Hyderabad, do you think eventually that market is going to be as large as what Bangalore is right now and what Chennai could be in 2-3 years down the line? Do we have envisage that kind of volumes being clocked in Hyderabad as well?
As it is, Hyderabad and Bangalore are running neck to neck. It is not that Hyderabad is way behind or anything. Chennai is a bit behind in terms of volumes, but Hyderabad and Bangalore are close to each other. Some years, some quarters maybe, Hyderabad has done even better. But I think they have much more stock, maybe 8 to 9 quarters stock, whereas Bangalore has 4 to 6 quarters.
Yeah, I was asking from our perspective.
Chennai has the potential to improve, certainly. That's what we feel.
Yeah. So I was asking for our perspective. Bangalore right now, annually does 6,000 odd crore of pre-sales. Do we strategize in a way that eventually Hyderabad should also contribute that much of sales for us?
Yeah. So no, certainly that's the desire. We are working towards that to get the right parcels of land in Hyderabad. Certainly, but that's the desire.
Sure. That's it from my side. I have a few more questions, but I'll join back with you. Thank you.
Thank you. A reminder to all participants, please press star and 1 to ask a question. The next question comes from the line of Parvez Qazi from Nuvama Wealth Management. Please go ahead.
Hi, good afternoon team, and congratulations for a great FY25. So couple of questions from my side. First, if you look at the average realizations for FY25 as a whole, roughly about 11,100 rupees a square feet, they were up about 40% YOY. Obviously, there was a change in product mix, and there have been some organic or like-to-like price growth. In your view, what would have been, let's say, the like-to-like or organic price growth portion within this 40% increase in realization?
So it's like-to-like, it's about 10% like-to-like because the big difference in the average price realization has really come from the product mix that we have been able to launch in the past year across all markets.
Sure. And now when we move towards FY26, again, what is your view, one, on like-to-like price growth? And second, do you anticipate further change in product mix which could push this realization even higher in FY26 beyond the like-to-like price growth?
No, so the way in which we plan our launches is to ensure that we're getting a good price at the time of launch itself, so that beyond that we see it growing for the same project maybe at 10% or so. And I think that is because the market is not in a price discovery phase anymore. People know what the price is and what they expect the price to be at the time of launch. And then it just, increases annually at a nominal number. In terms of new launches, how we are planning the way in which we look at it. So going forward also, I think we are assuming more the inventory that we have in our pipeline is assumed at approximately 10,000 rupees per square foot value or APR. So while in the past we've seen it go to 11,000 or high 11,000, we see whatever is in our next 4 quarters, we're looking at around 10,000 average. That's mainly from the product mix.
Sure. Second question is on the value versus the volume equation. So in FY25, our volumes were down 7% YOY, but our sales value was up 31% YOY. In your view, what will, let's say, these numbers be in FY26? Will we see more volume growth and lesser value growth in FY26? How do you expect the next year to pan out?
So definitely we will be aiming, we would always love to sell more in terms of area, but we have to keep in mind that also what it means in terms of ticket sizes to customers and the market's ability to absorb a certain type of ticket size. So naturally we want to push on both fronts, both on the area as well as the total pre-sales value itself. But seeing that the average ticket size, the average price realization is going to be around 10,000. I think we'll be looking to increase both, but hard to say really whether I'll, at what kind of percentage I'm going to see that grow over the coming year. But we are hoping to increase the overall area and naturally the value as well.
But I mean, in terms of sales value growth, would it be fair to say that we'll be targeting at least a double-digit value growth in FY26?
Yeah, double-digit is the typical sort of approach to try and increase the value.
Sure. And my last question is on Brigade Twin Towers. So just wanted to think what's our thought process towards leasing the balance portion that we have there.
Yeah, for Twin Towers, we have started, as you know, leasing and one tower for strata sale and ownership. And in some cases, we have investors also buying into the floor, so we are leasing the space for them. So I would say about 30% of the project has been leased or sold, and one tower we are keeping aside for a leasing client. We have applied for a few RFPs, and we are yet to hear back. So the sale traction has been good, but the number of transactions have been very high, but it has been a bit small. So while the transactions and there's a lot of demand end users, overall we've, like I said, sold or leased about 30% of the project, and I think it should see good demand in the coming year.
Sure. Thanks and all the best.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Biplab Debarama from Antique Stock Broking. Please go ahead.
Good afternoon, everyone, and congratulations for another stupendous year. My first question is on that only. Can you maintain similar kind of 25-30% sales value growth in the next foreseeable future? What's your take on this, on the pre-sales growth?
So we are typically looking at a 15 to 20% year-over-year growth. I think that is fair in terms of the base also in which we are continually adding. So that's kind of how we look at it.
And ma'am, for the last 3-4 months, we've been hearing a lot of a narrative that looking at the economy and everything, the real estate cycle may see some kind of moderation. Q4 numbers are good, but going forward numbers may be pre-sales or absorption may see moderation. As you said, last few years, the absorption, people are selling 50%, 60%, 100% on launch. That may not be tenable in the long run. So in April, May, whatever you are selling, have you seen any kind of moderation compared to what you saw, say, FY24, FY25, the kind of sales velocity you saw? Have you seen any moderation in the last few months in your portfolio?
Yeah, in Q4 there is some amount of moderation, and in April, every year there is always a moderation after the financial year completion. But May is looking brighter. May should be fine. But I think everything is a function of the demand, supply, and the affordability. But and also you need to look at holistically, not price alone, not volume alone. You have to see them together. See, when volume comes down a bit, people question us and volume has dropped. When prices go up, nobody appreciates that the prices have gone up. So I think overall we need to look at holistically. I think based on that, it's a combination of quantity and price. We expect to do overall better in terms of the revenue and profitability.
And one final question, compared to what you did in FY25, would there be any, are we going to see more contribution from the new markets, or the contribution from these three markets, Bangalore, Chennai, Hyderabad, will remain same? I'm just trying to understand from where you get this 15-20% growth.
No, it will be from within the three markets. We are not looking at a fresh city. Though we may enter one other city or so, no, not Mumbai or Delhi immediately, but more or less it is in these three markets.
Okay. Thank you, sir, and all the best.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question comes from the line of Pritesh Seth from Axis Capital. Please go ahead.
Yeah, thanks for the follow-up. So a couple of questions. Firstly, on Twin Towers, you mentioned, about the leasing, but just wanted to clarify that by what time we expect with 6 lakh square feet or which is vacant right now to be occupied?
We're targeting to complete by this fiscal year. That's the target.
By this fiscal year. Okay. And what sort of rentals are being built in terms of per square feet?
Yeah. The rentals we look at is currently between 70 to 75 rupees a square foot.
Okay, got it. That's helpful. And just one last on the cash flows or collections, if you can split that across businesses.
Yeah, certainly.
Just for this quarter. Yeah.
Sure. I'll just come back. You can ask the next question. I'll come back to that.
Okay. No, that's the only question. You can come back later. That's okay. Thank you.
Thank you. The next question comes from the line of Sabyachi from Bajaj Capital. Please go ahead.
Yeah, hi, this is Sabyachi from Bajaj Finserv AMC. I have two questions. First, on the residential piece, could you walk us through the timeline of major launches of this 12 million square feet that we have planned for FY26 across micro markets?
Sorry, can you just repeat that question again?
So I'm looking for timeline of launches, major launches across the three markets of this 12 million square feet that we have planned for FY26.
Yeah, so in Q1 in Chennai we will be launching one large development, and much like the two previous financial years, we'll be launching more of our projects in the second half of the year.
Okay.
So in terms of a trend, I think it's very, very similar to what we've seen in the last two FIs.
Got it. It will be second half heavy.
Yeah.
Got it. And what would be our current inventory pending? I mean, inventory is there on whatever projects we have launched? On
yes. 5 million square feet. Yeah. 5 million square feet already launched.
Yeah.
5 million square feet with an average realization of 10,000. That's the inventory value that we have.
It may be a little bit more because these are all the higher value projects that we had launched in the last year or so.
Got it. On the business development, is there any target we have for FY26? Any investment target that we have number for BD activities for FY26?
So our strategy has been, very, very stable through all the years. The way we look at it is from a medium term. What can we launch over the course of the next 4 to 5 years? So typically, the way we look at it is how much have we launched, or are we launching in the current year, and what we've done in the previous year, and we at the minimum look at replenishing that much amount of square footage. We've done about 11.5 million square feet of launches last year. We have added about 12 million square feet in the previous financial year. So we will continue to focus on similar lines.
Got it. Okay, that's all from my side. All the best. Thank you.
Thank you. The next question comes from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, so I just wanted to understand that there is this concern about the IT/ITES slowdown and the trade war. So over the years, what do you think would be the change in the concentration of the IT/ITES customers for us as a percentage? Do you see there is any change in the trend, and how do you sense this thing, given the war concerns on the demand from IT/ITES? What are you seeing really on the ground?
By and large, I think a trade war is getting resolved on its own, but nobody can predict Mr. T. So I would put it, things should resolve faster than one can imagine, the way the so-called war between India and Pakistan got resolved earlier than expected. And as far as Bangalore market is concerned, it is, yes, a lot will depend on the IT sector performance. But having said that, whenever there is any kind of so-called recession or a slowdown in the United States, the IT sector improves in India much more than expected, so that the American companies can maintain their profitability. And as is known to everybody, there is a huge rush of GCCs, Global Capability Centers, in the last 1 year particularly. And that trend is likely to continue. I think Indian capability is appreciated globally. That's why the GCCs are coming to India in a much faster pace. So that way, IT is here to stay. And I think by 2030, we might exceed nearly $1 trillion of IT business is what is expected.
But I'm also, looking at the 7,800 crores out of sales, pre-sales this year, so any ballpark sense and guesstimate what would be the contribution from the IT/ITES in this?
So there is no specific contribution from IT/ITES as such in terms of sales, no? Is it sales or leasing?
Pre-sales. I'm talking about the 1,700 crores of sales, residential sales, which we did this year. So approximately what would be attributable to the buyer or the customer coming in from the IT/ITES sector in this?
Yeah, see, actually, because we are in these markets of Bangalore, Hyderabad, Chennai, the proportion across the board, if I take all three, must be around 60-65%. We have been getting this question about IT services and so on, but I would say over the last 10 years, the profile of what is considered as IT as a job has really gone up the value chain. So previously, we all looked at Infosys, Wipro, and so on as like your potential companies from where you get your customers. Now, because of the way the economy has also grown and the kind of jobs that are there, the growth of GCCs, we're seeing a lot of people in GCCs or companies where they have tech roles or digital roles. Those are the kind of customers we're getting. And that's happening even in much higher, even in more premium projects within our own portfolio. So we're seeing that customers are from a tech background, maybe not necessarily working for your typical IT services firm, but they have that kind of tech. Tech is sort of the reason for their employment. So I think we should look at it from a more holistic basis.
Okay. The next question is, now we are at almost 878 or 8,000 crores, and next year, even if we grow 15-20%, we'll touch that magical number of close to 10,000 crores. So at what point of time in the life cycle of genesis of the company do you think that you need to diversify now beyond South and look at probably starting with MMR and then NCR? So and planning for the same, at least you need to plan at least a couple of years in advance, look at client opportunities. So in terms of readiness and growing from here on, so how do you sense these opportunities outside South?
Yeah.
I think in FY26 we'll take that call, I would say. We'll take that call. What to do is something we need to decide. Because we feel these three markets are quite strong and able to, absorb higher volumes. But in terms of pure volume, it is Bangalore, Hyderabad, and followed by maybe NCR is the one which comes under volumes. But in terms of price, it is Mumbai, Gurgaon, and then Bangalore, southern cities will come. So we need to see when to bite the bullet.
Okay, so will MMR be the first preference at all if that to decide MMR, Pune, so which will be more aligned with your current product, current markets? So where do you think would be the first move? Or maybe NCR?
I think time will tell.
Okay, sure. Just the last question, Pavitra. So this year we have seen 54% contribution coming in from the new launches. Typically we have seen new launches contributing for others or peers as high as 65% to 70%. Do you think that even going ahead, the sustenance share will keep growing and new launches will become lesser of a contributor to the pre-sales?
Yeah, so actually said about 54% this year came from new launches. So I actually think that it's a healthy number because our sales is, I don't think it is great to have a number that is 70-80% all on new launches, because the approach is to have a healthy launch and to also leave some inventory for sustenance. So our plan is not to sell out on day one. We will not make those kind of announcements because that's not part of our approach anyway. So going forward, I think a 50-50 in terms of new launch versus ongoing, and there is always very minimal sales coming from what is seen as completed. It's almost negligible. But as the cycle continues to evolve, we'll have to see how this goes. But in general, I think we have settled into a pattern where we look at, say, 40 to 50% of of any new launch should be sold within the first couple of quarters. And then we take the rest of the construction cycle to sell the remaining inventory. If we're able to increase price and still sell, then we will look at it. But there is no hard and fast rule that I need to sell everything up front. And that's why I think around 50 to 60% from new launch is what we'll continue to look at.
And just, are you handy with the number for FY24? What was the contribution from the new launches in FY24 sales?
Yeah, around 62% or something like that.
62?
In FY24, yeah.
62, okay, got it.
Yeah.
Okay, thank you team, and I wish you the best.
Just a response to the earlier question, that is split of the collections across three verticals. So total collections for the year was 7,250 crore. In that, real estate was 5,412. Commercial lease retail business was about 1,197 crore. And hospitality was about 642 crore.
Thank you, sir. The next question comes from the line of Parvez Qazi from Nuvama Wealth Management. Please go ahead.
Hi. Thanks for taking my follow-up question. So firstly, would it be possible to get a broad split of our pre-sales in FY25 across the three cities? I mean, even a rough cut number would be fine.
In terms of the overall value or just as a percentage?
Yeah, I mean, either way is fine, yeah.
Okay, so just approximately, I will say Bangalore was around 5,000 crores, Chennai about 1,000 crores, and Hyderabad 1,400 crores.
Sure. I mean, you gave a number of 54% contribution from new launches in FY25. For Q4 also, the number would be more or less in the similar range?
Yeah. For Q4 also, it is around 55% new launches. It was a little steep, but that's why it kind of averages out around 55% for the year.
Sure. And lastly, the land that you have bought opposite ITPL, the office project that we make will be on sale model or a lease model is also possible?
No, it will be primarily a lease model.
Sure, sir. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, the last question comes from the line of Biplab Debarama from Antique Stock Broking. Please go ahead.
Sir, my first question is on the business development you did in this financial year, FY25. In terms of GDV ballpark, what would be that number?
The GDV will be upwards of 12,500 crores.
Okay. And now coming to the pre-sales, new launch sales. So 54% of pre-sales from new launches. That means you have sold around 4,000 crore plus from new launches in this financial year. And you have launched around 11,000 crore in this financial year. So that means ballpark around 40% is the absorption of new launches, new project launches. If that is a ballpark number is correct, so is it a high number or okay number or a moderate number? Because 40% of absorption in pre-sales, I thought pre-COVID it would be something around 25-30%. So it doesn't look like it's a too high a number in terms of absorption of new launches.
Yeah, your calculation is more or less correct. We also have to see the timing of the new launches. So, I only had 1 month to do the new launches, and that is the kind of value that I can probably manage within that. As I mentioned earlier, we will look at how much we can do within 1 quarter or 2 quarters of the launch and consider that as our overall launch period. Because we aren't trying to, sell everything at one shot when we launch. So considering that some of our launches came in, like Brigade Eternia, basically came in at the last month or so. Allstate came in February. So basically, we didn't have too much time to absorb even more within the financial year itself.
So what would be the typical absorption in the first year of launch? Comfortable number that would give you comfort?
So yeah, around 60%.
Okay.
I would say in the last couple of years, there are some projects which we fully sold out within 1 year itself. So it's not typical. Whatever we saw in the last 2 years is not typical. And whatever was pre-COVID is a different. Yeah, it's a different time entirely. So post that, as I mentioned earlier, we look to sell around 50 to 60% within the first year or so. If it is faster, then we will try to attain a certain price appreciation and not necessarily just sell off the inventory very quickly.
So anything below 50-60% is moderate, and anything above 50-60% is exceedingly well. That would be the.
Again,
that is what
we have different strategies. We have different strategies for different projects. So if it's a volume project, I look at it differently from like a high-end, smaller inventory type of project. So we will look at it based on what is best for that particular size project.
Okay, thank you, ma'am, and all the best.
Thank you.
Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Ms. Pavitra Shankar, Managing Director, to give her closing remarks. Ma'am, please go ahead.
Yeah. Before we wrap up, we'd like to share a few key highlights beyond our financial performance this quarter. We launched the Earth Fund, a sustainability and PropTech-focused investment fund in collaboration with Gruhat, the investment arm of Nikhil Kamath and Abhijit Pai. This SEBI-registered CAT2 alternative investment fund has a corpus of 200 crores with a 100 crore green shoe option. The fund aims to support high-growth startups, driving innovation and sustainability in the built environment. Nirupa and I were named among Fortune India's 100 Most Powerful Women in Business 2025, ranked 80th alongside leaders such as Kiran Mazumdar-Shaw, Neeta and Isha Ambani, and Falguni Nair. The Brigade Foundation broke ground on the upcoming St. John's Medical College Hospital at Brigade Eldorado, a 108-bed facility in North Bengaluru. Brigade Group was ranked 10th in Fortune India and CLHR's Top 50 Future Ready Employers 2024 list, highlighting our progressive and people-first workplace practices. World Trade Center Kochi has been designated a premier accredited member by the World Trade Centers Association, the highest level of certification. With this, all three of our WTCs, Bangalore, Chennai, and now Kochi, have achieved this prestigious status. A few awards and recognition. Brigade Tech Gardens won for Best Practices in Water Management at the BCIC ESG Awards 2025. Brigade Tech Gardens was also awarded the Shotcrete and Waterproofing Award by the American Shotcrete Association. Brigade Citadel was awarded Residential Project of the Year at the second Realty Plus Excellence Conclave and Awards, Hyderabad 2025. Brigade Parkside North received the IIA Award for Excellence in Architecture under the Residential Architecture category by the Indian Institute of Architects. Brigade Foundation has been partnering with the Go Sports Foundation, supporting the Equal Use Cricket Excellence Program, delivering hundreds of impactful interventions involving 30-plus experts and 10 high-performance sprints. The program has proudly nurtured 3 Indian national team players, 4 IPL players, 3 India under-19 team members. On that note, we conclude this quarter's earnings call. Thank you for your time today and for your continued interest in the Brigade Group.
Thank you, ma'am. Ladies and gentlemen, on behalf of Brigade Enterprises Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.